the decision of the RBI to cut interest rates today does come as a surprise, because while we did expect a change in the stance from calibrated tightening to neutral, a rate cut didn't seem to be on given the fact that the inflation potential still remains. In fact, surprisingly, even though the inflation potential remains and the RBI has highlighted it, they've still gone in for a rate cut. The reason ostensibly is because they're concerned about growth, because they feel that growth will not be changing much next year at 7.4%, and therefore these interest rate cuts will help to boost growth in a way. Now, whether this will really help to translate into lower interest rates waits to be seen, because while retail loans in particular would benefit in case interest rates come down, because given the fact that the budget was also given incentives to the housing sector, if we combine the two, it looks like that households should be better off. We're not quite sure if the corporate loans are going to become cheaper, because with the NPA overhang, banks may be a bit slower before they actually lower rates on corporate loans. But from the point of view of the banking system, this should be positive, because in terms of the GSEC yields, they're going to move downwards, which means in terms of valuation of their portfolio, that should receive a positive thrust. So on the whole, what we can expect is that the RBI could probably be having some more rate cuts in store for us, maybe 25 to 50 basis points, depending upon how inflation behaves in the coming months. And given the fact that the RBI still feels that the inflation rate will remain less than 4%, there's a very strong chance that we could have these cuts coming.